From households to governments to big businesses, global debt has increased by 50% since the crash of 10 years ago. Are we inviting another financial crisis? Welcome to Round Table. Good to have your company. I'm David Foster. Credit card debt up, car loans commonplace, student fees taking a lifetime to pay off. Major corporations borrowing by the billions. Hard to argue with the idea that we have become addicted to debt.
Figures from the Institute of International Finance show global debt has reached over $250 trillion. Paying that amount off by $1 each second would still take more than 7 million years. The 1970s brought the liberalisation and deregulation of the world's financial system. This led to the abundance of cheap credit, leading to unsustainable borrowing levels, contributing to the financial crash of 2008. If we continue with today's economic practices, economists say we are inviting a recession even worse than the previous one. But the next crisis could have different causes. Last time it was high consumer debt, this time high levels of corporate debt are causing alarm. The concern is that the taxpayer will bear the greatest burden. After the last crash, the public sector bailed out JP Morgan and others who were seen as too big to fail. Meanwhile, China buying up debt by the billion could give it a political and economic advantage over rivals. Can the mountain of debt carry on growing forever without consequences for us all?
OK, let's get the conversation going. We go to Manchester first. Beverley Budsworth joins us from there, Managing Director of the Debt Advisor, who advises people in debt. At the round table, Garrick Hileman, Head of Research at blockchain.com. We welcome Osmond Plummer, Senior Lecturer at the London Institute of Banking and Finance, and David Belle, UK Growth Director at Trading View. This is one question, but it's directed at each and every one of you. But I'll start off with you, Garrick, if I may. Is this lending, massive amount of lending, stupidity, irresponsibility on an industrial, catastrophic scale, or without it, would the words financial systems collapse?
So it's very difficult to know how much debt is too much debt. There is no red line in the sand that says if you cross this and you take on this much debt, if you're a government or a corporation, you're automatically going to default. It really is a confidence game. And so we don't know if the lending today that we're seeing is irresponsible. Certainly some governments, if you look at it historically, are well below the highest levels we've seen throughout history. Britain, for example, after World War II, had a debt to GDP ratio of over 270%. The US is well less than half of that. So perhaps the US can take on even more debt, but maybe not. Maybe the circumstances have changed and countries like the US are actually a lot closer to that red line than we think.
So you won't know that the red line is there until you've basically crossed it or fallen off the cliff edge?
Unfortunately, that's it. It's a confidence game. It's about the availability of liquidity, and once that dries up, then you know it's too late.
And Osmond, in your classes, you have a chart that shows where that red line is, don't you? How much debt is too much?
It shows that there is a maximum amount of debt beyond which we come over a precipice. It just doesn't inconvenience itself with having numbers as to what that actual amount would be.
Is it a proportion? Is it a percentage? Is it
has
imaginary?
no numbers, it has no percentages. It just says there is a maximum. We just don't really know what it is.
Are we close to the maximum?
Well, we're closer than we ever have been because we've got more debt than we've ever had. Globally, it's around 330% of global GDP at the moment, the highest it's ever been. In Europe and the US, it's nearer 380% overall of their GDP. These are large numbers, but at this point, as Garrick said, it's a bit of a confidence trick. It keeps going until the music stops.
OK, David, a debt is only a problem if somebody decides to call it in. Am I right here? And what are the chances of these massive amounts of money? And Beverley, we'll come to individuals in just a moment. What are the chances of these massive amounts of money being asked for?
Well, I think it lies predominantly with when the consumer thinks that debts need to be called back in. We have to remember that economies are very much reliant on consumers, and then the businesses are reliant on those consumers as well. And
You mean when the consumer decides they're not going to borrow anymore?
Exactly. We've currently got extremely low levels of unemployment. If those levels of unemployment start ticking back up, we'll get another issue with, like we did with 2008, a credit crunch. And that means that businesses then stop being able to finance their debts. And we start seeing issues with the corporate debt market as an example. But I think if we want to talk about where the responsibility lies and whether it has been an irresponsible policy to encourage this gorging of debt, we have to talk about central banking. If central banks are lowering the cost of borrowing so much and inviting people, businesses and different entities to take out so much debt, then surely if rates start to reverse again, because obviously we've had a very, very low rate environment. If
The money's cheap at the moment, but if it changes...
But if it changes, financing costs are going to go up, and people are on that kind of precipice of not being able to finance.
And we will talk at this table about why that has happened, why lending has been so cheap and what it's done. And so, but Beverley, I want to come to you about people's personal debt. And I should say that before you started to run Debt Advisor, you were with Deloitte, so you saw it on a corporate level as well. But what personal debt here, how much of a problem is it now in the UK? And how does that compare with other times when there have been credit crunches, 2008, back in the 1980s when it was boom and bust as well?
Well, we're certainly getting back to the pre-credit crunch figures in terms of consumer debt levels. We're not quite there on an individual basis. I think pre-credit crunch, it was £4,600 of sort of individual debt, and they're just below that at the moment. Individuals, the reasons for people getting into debt now compared to the pre-credit crunch are different. Pre-credit crunch, there was quite a lot of sort of overspending. But what we see now is, disposable income is much lower. People's ability to withstand shocks is much thinner. Citizens Advice have reported that 40% of people that they see have no disposable income. They've had any shocks to their income, relationship breakdown, and the universal credit problem has left people, a large proportion of people struggling.
I should explain to the audience out there in the wider world that the universal credit was a readjustment of the benefit system in this country, which has been criticised for one reason or another. So you were saying then it was about extravagance. Now it is perhaps about survival. Which element of society then is more likely to find any kind of squeeze on them more difficult?
So it's the lower earners, without a doubt. I mean, you do get, debt levels with higher earners, but it's the lower level.
So they are perhaps more vulnerable now than they ever were. And any kind of crash, any kind of wobble, if you like, could set them on the path to some kind of ruin, if you like.
Okay, well, we do have a rescue culture in this country, so there are things that people can do when they get themselves into problem debt. But what we are seeing is that the numbers of people that are sort of going into formal insolvencies is at a peak now. I think we're expecting about 133,000 this year, and it hasn't been that high even pre-credit crunch, I think.
OK, so we have massive levels of personal debt. We have high corporate borrowing. We have governments borrowing, sovereign debt here as well. And the US Federal Reserve saying the decade of cheap money's created corporate debt that poses, quote, financial stability concerns. Now, if they are saying that, the US Central Bank, then should we all be a bit worried?
Well, they're the ones that have caused it. So it's very, very ironic that the Fed always come out with these statements. And past Fed governors like Janet Yellen has come out and said that, oh yeah, debt levels are too high post her chairwomanship. It's really, really ironic that they do say this. 40% of the US firms in the Russell 3000 make no money at all. They're only kept alive by this cheap financing and cheap borrowing.
So you're saying that if interest rates went up, that would be the end of them?
Exactly. It's created a misallocation of capital on a massive, massive scale. And at some point, that capital is going to have to be reallocated much more productively. And my view is that will come if rates push up again. We're seeing inflation expectations globally begin to push up. And what's going to happen is that these central banks have pushed themselves into a corner with this massive debt-based expansion. And when those rates push up again, everyone will be stuck.
OK, so whether the Fed caused it or not, the Fed is saying there are financial stability concerns. And when they say that, should we, not just on an individual level, but looking at our national stability, international stability, should we be concerned?
Yes, absolutely. So I work at blockchain.com, which is a cryptocurrency company, and we continue to see strong demand for crypto assets like Bitcoin, in part because of concerns around the level of debt, central banks, manipulating, equity markets and whatnot, and the feeling that, at some point the music's going to stop and whoever doesn't find a chair is going to be left holding the bag. So having ownership of an asset that's disconnected from the financial system is something that's proving more and more attractive to people around the world.
Yeah, but why have we got to this point? Is it just because the Fed said we're going to have cheap money, you can go out and borrow it, we need to stimulate economies, we need to print money, quantitative easing after the last crash? Why has there been nobody really who's taken a good look at this and said, we haven't learnt the lessons of the past? Or is this entirely dissimilar?
I think we learn lessons of the past in the short term, and in the long term, we forget them. What you're seeing here is with artificially low rates and the short-term nature of US capital markets, there's an incentive for senior executives in corporations to borrow, to buy back shares, to increase earnings per share, to increase share price, which affects on their bonus. This is a very short-term solution, but it's one that's been pursued by a lot of companies. And David was talking about a large number of companies not making money. There's also been a huge increase in the United States of corporate borrowing at the just into investment grade level. Now, if things do turn around, you may find a lot of that debt ceases to be investment grade, and that has knock-on effects for costs of borrowing, for costs of refinancing, and how the markets might react to that. So there's a lot of risk, I think, at the BBB rated, and a lot of onus will come back onto our friends at the ratings agencies and how they will react as the economy progresses.
IMF's deputy director, a guy called David Lipton, warned of the depleted power of central banks and governments to combat another sharp economic shock. And he says the tools used to confront the global financial crisis may not be available or as potent this time around. So what's changed? Because I thought we'd supposed to have tightened all of this up.
There comes a point where you reach the zero lower bound. You can't do any more. So the only way that you can affect the supply of money or monetary demand is by printing more money, essentially, because interest rates can't go any lower. I think you've got Europe and the Eurozone at a negative 4% deposit rate. You've got Japan with negative interest rates as well. Japan's probably the kind of forerunner in low rate policy and quantitative easing. Their growth over the last 20 years has been absolutely shocking. And now you've got the ECB president, Lagarde, pushing for Eurozone governments to increase their spending to now stimulate growth. It's proven that monetary policy hasn't worked, or this new age of monetary policy.
You're listening to all of this, Beverley, and it's very instructive, but it's quite dry, and it doesn't take into account the personal misery, the stories that you hear and see every day.
Yes, I mean, we help both individuals and businesses, and what we're seeing is that, for the sort of the smaller businesses, the SMEs, it's become more difficult to get mainstream lending. So overdrafts are becoming much more expensive, and so you've got a lot of secondary lenders that have entered the market, and business has become even more difficult to make it profitable. So we're seeing a lot more failure in the smaller SMEs. This leaves people with quite gargantuan personal guarantees. So people end up clutching at straws. They end up continuing to borrow just to try and keep their businesses alive.
And the knock-on effect of all of this is if a business is struggling and it can't continue to employ people, then the employees who are no longer in work are going to find their own personal lives as damaged as that of the company itself.
Yeah, and we've seen some quite large failures, Thomas Cook and the likes. You've got the retail sector really badly affected. People are sort of are not spending as much, not dining, not spending on the high street, and so we are seeing those failures, and it leaves people redundant, and it is difficult to get themselves back into work again.
OK, Beverley, thank you. Thank you very much indeed. Let's step away from some of the corporate stuff and intergovernmental stuff and just ask you the straightforward question, each one of you. Say, are we heading for another almighty financial mess?
Financial crises are inevitable. It's never a question of if, it's always a question of when. And, we don't know when the next one's going to come. We just know one will come. And history often rhymes. It doesn't always repeat. So we'll probably be similar but different from what we've seen in the past. We certainly have seen debt levels grow in government balance sheets. Central bank balance sheets have grown a lot. So there could be, a different flavor to the next crisis.
But was it not all about sort of unbelievably risky loans in the past on these worthless mortgages, particularly in the United States? And yet here we are seeing something entirely different. A lot of it's government debt, where China's lent money to Pakistan and other countries where it wants to expand its influence on the Belt and Road Initiative. That was very, very different. Is there anything from last time that fits in with what we're seeing now?
I think now it's quite different. It's the consequence of the reaction to what happened last time. So the reaction to the last financial crisis was essentially throw as much money at it as you can, and to increase vastly the borrowing of nation states in particular, to the extent that we've got to a point now where we are nearer to what the maximum is possible, is allowable, is workable. And you do have potential for there to be investor confidence issues, and it comes down always to investor confidence.
And so if investors start to take their money out,
That's right.
Then the markets
of
could
cards.
turn, and these things, sentiment can turn very quickly and very severely.
So what I'm wondering is, I mean, you're all very knowledgeable about this. You're sitting around saying, look, it's not if, it is when. We're talking about levels of indebtedness, the low cost of borrowing, etc. I mean, even to somebody who doesn't understand it that well, I can see the danger signs are there. Why is nobody anywhere seemingly pulling back?
Because I think the world is addicted, if we rephrase it, they're addicted to liquidity, which is a function of debt. Markets at the moment are being propped up a lot by a good US economy. The US economy is doing well, growth's at 2.4%, inflation's doing well. However, one aspect that I really, really think that we need to be watching is if that inflation does push up a bit more, because warning signs will be there for a rate rise, which will, in fact, end up deleveraging and raising financing costs.
A sensible person, in other words, a sensible world, would not borrow more and more money when you know that it's going to get you further and further into trouble, which is what appears to be happening at the moment.
I think, it's exactly that. The growth is still there. Growth solves a lot of debt problems. That's what policymakers always kind of count on when they kick the can down the road and don't want to deal with the debt problem, that we'll grow our way out of the problem. If you can keep growing, a lot of your debt problems can be managed. And then inflation is the other key metric. With inflation so low, because of all this new labor that's come onto the market from Asia, China, low-cost labor, kept inflation low. Central banks still can really manage the economy quite effectively. If inflation starts to creep up, their hands get tied, and markets will lose confidence in the ability of central banks to manage price levels and affairs. And so that is really, I think, something we all have to watch very carefully, is what's happening with inflation and also what's happening
But
with
is there
growth.
anything they could do? And I say they, as they're a great amorphous mass of influencers worldwide when it comes to the financial markets. Is there anything that they could do now to avert?
No.
No,
they can't. Most of them are
Why
talking
not? Are they
heads
idiots?
anyway.
well, it's not that. It's the wherewithal to do it. If you are going to avert a crisis, you're going to have to start paying back debt. And debt has only been going up. Governments do not have the revenues at this stage to pay back the debt they owe.
Do you remember when hire purchase used to be called the never, never?
Yes.
That's effectively what we've got here, isn't it?
Effectively. And without any significant inflation, you're not devaluing the debt, which used to be something you could do over time, effectively to allow you to have greater revenue in the future to pay it back. So it's a bit of a catch-22.
And I think, referring to inflation as well, central banks tend to target CPI inflation, which is the consumer price
the price
index.
of things.
Yes. However, if you look at asset prices, they've just gone up and up and up. So pretty much all of the effects of the policies of the last 10 years have gone into asset prices, which affect poorer people predominantly, rather than the actual policy that they look at to determine interest rates.
Beverley, you've worked in the corporate world as well. You see and hear personal stories on a daily basis. They're saying it's if, not when. They are saying that nobody is doing anything about it, that nobody can do anything about it. Is this stupidity on the most enormous scale?
I mean, the Financial Conduct Authority are trying to do something about it. They've brought in new rules about credit cards, and for the first time in October 2019, we've seen credit card debt actually decrease by 200 million because they brought in the rules, I think it was March 18, about persistent debt. So if over an 18-month period, somebody ends up paying more than the interest and charges, and all they're doing is minimum payments, they deem to be in persistent debt. So the FCA is trying to do something about that because, the financial institutions make an enormous amount of money out of people, interest charges on credit card debt. FCA is trying to bring that bill down by 1.3 billion a year.
You see, I'm wondering whether, the house is about to catch fire. Interest rates are incredibly low. It's all going to go wrong anyway. Nobody may come after me. Now might be the right time to go out and take out the most massive debt, knowing that the party's going to be over in a couple of months anyway. You would say that was rank stupidity, would you?
Well, if you've got a property and it's got equity in it, taking out debt, the debt has to be repaid, and if you do bankruptcy or an IVA, your equity's at risk. So yes, it is stupidity. I guess if you haven't got any assets, then it's less risky, but you're unlikely to be able to borrow significant sums.
Okay, so I won't do that. Addicted to debt's the question. I mean, addicted to something that is never going to be cured.
Yeah.
David, you first there.
I mean, as a trader, I look at the S&P 500, for example.
Standard & Poor, American.
Yes, yeah. And if you look at, yes, there's an element of the US being a good economy compared to many others and a great place to invest. But there is also the other element of what the Fed is doing in terms of the repo market and things like that. And I look at it as a pure liquidity thing. And yes, people are addicted because the Fed tried to raise rates by just 25 basis points a couple of years ago.
Which is a
quarter of 1%. And the markets kind of went crazy. People started to get really scared. Now, if an economy cannot sustain a 25 basis point rise in an interest rate or financing rate, if you want to call it that, then surely there is an addiction to this debt. That's got to be the most ardent proof for it.
And it's going to be like cold turkey all over again, once a decade, once every 15, 20 years, once a generation. Nobody learns and it'll just carry on.
It's more often than once a generation, on average. These things come around with quite alarming frequency. And it comes back down to the old adage that if you owe the bank £1 million and you can't repay, you're in trouble. But if you owe the bank £1 billion and you can't repay, the bank's in trouble. And we're in a similar sort of environment. The numbers are so vast that actually one of the reasons the reaction to the financial crisis 10 years ago was to throw all this money at it was because liquidity...
Well, it wasn't real money, though, was it?
No, it was electronic money.
They just got their printers out.
Make-believe money.
Yeah.
But it was thrown at it because there was concern the financial system could cease to function.
Okay.
Current form.
Are you worried about this, or are you just quite sanguine?
Well, I think some kind of crisis is inevitable, and it's going to be potentially very catastrophic if it's not managed properly. I think,
Worse than last one?
Possibly, yes, because the debt levels are higher. Growth, we've got an aging population and a lot of the traditional engines of growth, as well as new engines of growth like China. China's going to get old before it gets rich. What happens to the world then when we can't rely on outsized Chinese growth to kind of help prop up this massive mound of debt? That's one of the reasons a lot of people are, like I said, getting exposure to assets outside of the traditional financial system like Bitcoin. There's a compelling argument for investing in something that
Well,
is...
that's for another program. Isn't it wonderful that we as a human race, Beverley, and thank you very much indeed, we as a human race are naturally optimistic, I think, because if you just laid these out and said to somebody, would you like to be a human being for the next 30, 40 years, and you're going to get in all this trouble and they're going to have the banks chasing you and they're going to have austerity, they would probably say no. But tomorrow the sun will rise again and we'll be there to see it. Thank you very much indeed. A rather worrying forecast from our guests, and the problem seems to be that it'll happen time and time again. When will anybody learn? The feeling is that you can't learn. You can't do anything about it. From me, David Foster, from my guests, thank you very much indeed for watching this edition of Round Table. Until next time, goodbye.